Good afternoon, everyone, and welcome to our webinar today. My name is Svitlana Buriak, and I'm an assistant professor at the University of Amsterdam. Today, we have another exciting webinar about intangibles and transfer pricing. And we will continue with our dear guests, Michael McDonald and Marta Pankiv. And let me introduce the topic first. So today we'll cover the topic on group intangibles and the relevance of contracts and DEMPE in the allocation of income in transfer pricing. Today's speakers, as I already mentioned, Michael McDonald. Michael is Managing Director at the National Tax Department at Ernst Young in Washington. And he's also a lecturer at University of Virginia. And Marta Pankiv, she's head of group tax and transfer pricing at Tricentis, and she's lecturer at University of Lausanne. So as I mentioned, my name is Svitlana, and I'm assistant professor at the University of Amsterdam and also tax advisor at Loyens & Loeff. And Rutger Hafkenscheid also joined us today as a moderator of this session, and he's a partner at Huygens Quantitative Tax Consulting and also a lecturer at the University of Amsterdam. I'm very sure that you are aware of the concept of DEMPE, and many of you probably would ask me why this slide is here. However, for those people who do not know the concept of DEMPE, we decided to just not throw an acronym straight away, but just to describe what DEMPE stands for. So DEMPE stands for development, enhancement, maintenance, protection, and exploitation of intangibles. So what does it mean? DEMPE is an acronym identifying the most significant group of functions related to intangibles in the functional analysis for transfer pricing purposes. And with this, I'm giving the floor to Michael McDonald and Marta, who will discuss in detail about the concept, the historical evolution of the concept of DEMPE, the relevance, and what is important interpretation and sometimes misinterpretation of the concept of DEMPE in practice.
Okay. Yeah, so thanks very much, Svitlana. I think that was a really good introduction, and I thought it would be good to start out with history, because I think in this case history is kind of helpful to properly thinking about this. And just for like background, this to some extent reflects my views of it, but I was at the United States Treasury at the time a lot of the key US regulations were written on this topic. And I was also a US representative to the OECD when what is now being referred to as the BEPS 1 guidance was written. That basically introduced this acronym, and so I actually do think it's relevant to put it in a historical context. But and again, with full disclosure, this is effectively my view of it. But remember, it's the view of one of the persons that was there writing this thing and thinking about it, and as in my country, thinking about how it properly fits into transfer pricing. So I'll just start with the U.S. regulations. Back through the 1968 first regulations, there was a sort of a confusing concept out there in transfer pricing, and I think it's something that we've all kind of dealt with, and it's the concept of legal ownership, which is kind of a clear concept, versus this somewhat fuzzier notion of economic ownership. And I think we all know what we're trying to say when we talk about economic ownership. It's the idea that, hey, there's an entity that legally owns the patents, but there might be another associated enterprise where it basically does all the valuable things and it makes all of the investments. And so to try to capture the idea that, hey, we have to make sure at the end of the day they're properly remunerated, we've thrown around concepts like economic ownership. Now, the problem with that is it's not really a clear concept. And the US regulations sort of struggled for years trying to deal with this concept. And I think the breakthrough occurred when the US decided to abandon this term. Not helpful. And so the concept of, in the US regulations, look, when we're talking about ownership, it's legal ownership we're talking about, right? That's the only concept of ownership, but it's not in itself determinative. And there are clearly can be cases where the non-legal owner makes such valuable contributions that under the arm's length principle, they should be properly remunerated for what they do, right? That's a concept that everyone can agree with. It's a concept that has been there for generations. And the regulatory approach that the US took was to say, let's not be sidetracked by trying to define economic ownership. Let's simply say what we mean. Legal ownership is the only ownership recognized, but you have to make sure that you properly remunerate everyone that contributes. So that's the idea. Now we step into what is, again, now being referred to as the BEPS 1 discussion. At the time, we didn't know there'd be a BEPS 2, right? So we just called it BEPS. And you will actually find, if you go through the transfer pricing guidelines, you will not see the term economic ownership. It's gone, right? It used to be there. If you did a text search prior to BEPS, you'd find it. And in my view, the things that the US tried to do in its regulations were also done in the OECD transfer pricing guidelines, because there's a sentence that talks about ownership, and it basically says what I just described. It says, hey, legal ownership is kind of the sole ownership concept, but it's simply a fact among other facts, including what are the returns that need to accrue to everyone, including the legal owner and the non-legal owner. And so in chapter 6, we kind of laid out these concepts in a way that I thought was helpful, because it was basically saying the same thing that we transfer pricing practitioners have been trying to deal with for generations, but hopefully tried to put it in maybe a clearer context, which would make it easier for practitioners. And practitioners means taxpayers, it means tax advisors, it means governments, to try to actually apply the arm's length principle in a way. And so it basically says, as you see in those bullets, the status of legal ownership is the sole ownership concept. But of course, all contributions to value must be appropriately remunerated, right? And so there's a paragraph in there, and I think this is the first paragraph where that acronym came up. It says, hey, notwithstanding legal ownership, other members may have performed functions or made other contributions that contribute to the value of the intangibles. So make sure they're properly paid, right? And at the time we were writing this concept, hey, others may have made important contributions other than the legal owner, make sure that they're paid. And by the way, when it comes to intangibles, what are some important functions or activities that you might be thinking about? Well, there's development of intangibles, there's enhancement, the maintenance. Now the problem is, so you see that conclusion at the bottom. At the time that paragraph was written, I remember commenting to the other countries around the table, okay, people are going to make fun of us because paragraph 6.32, even though it's true, it's the most obvious and innocuous concept in the transfer pricing guidelines. And I thought the reaction would be, well, duh, of course, that's what you're supposed to do. Now, the problem, and again, this is purely my opinion, is when we were writing out those activities that are relevant, development, enhancement, it formed an acronym, always a bad thing. That's what happened when we were working on the Article 7 profit attribution, where we came up with key entrepreneurial risk-taking functions. CURT became an acronym. So everyone's applying CURT all over the place. DEMPE kind of had the same thing happen to it. And so I think people aligned to this acronym assign all sorts of independent importance to this DEMPE thing. And in a sense, the rest is a very muddled history about how DEMPE is properly interpreted. So this slide is called The Life of DEMPE. And of course, everyone recognizes on the right, that's William Bendix, who in the 1940s in the United States had a radio show called The Life of Riley, right? So you get the joke. Obviously, you guys all picked up on that from the beginning. But this is what I call it, The Life of DEMPE, because this most innocuous of concepts from my view and from the view of the United States and from the view of a lot of people that were actually in the room writing this innocuous concept of DEMPE has taken on a life of its own. And again, if you do a textual search, you will not find DEMPE in chapter 1. Chapter 1 is very important because that's the one that says, what exactly is the transaction that we're trying to price? Let's define this transaction in terms of who assumes ownership, who assumes risk, things like that. What is the deal? DEMPE's not there. Not there. DEMPE is, in my view, but I also think it's simply clear in the textual analysis, DEMPE is a valuation concept. DEMPE is that thing that says, hey, at the end of the day, make sure everyone's paid properly for what they do. And by the way, a non-legal owner can contribute so much that they may be entitled to the majority of anticipated profits, right? But here's some things that, in my view, are going on. There's a conflation out there between DEMPE and control over risk, right? Again, through a pure textual reading of chapter 1, that's impossible because DEMPE doesn't appear there. So how are we now putting into chapter 1 something that's not there? But there's a conflation, in my view, of wherever there are the so-called DEMPE functions, again, the acronym, there must be control over risk. Also conflating DEMPE with unique and valuable contribution as a matter of course. Another thing I find is that a lot of times when people are looking at it, they're looking at it now, ignoring what might be prior year DEMPE activities, right? Prior year investments that are completely relevant to the current year's determination. And then the next two are sort of, I think, key. Conflating DEMPE, the concept of DEMPE, with a method, that there's somehow a DEMPE method. And I know that there are valuation analysis that basically, you know, they actually play out the acronym D and E and M, and they assign values to it, and they have these models that do it. And people get hung up by the fact that there are 2 E's in there. Oh my God, there's an E that appears as the second, but there's another E that appears as the 5th. Oh my God, there are 2 E's out there. And anyway, I really think that that's ultimately what that becomes is a conflation of Article 9, which is transfer pricing under the arm's length principle, with Article 7, which is PE profit attribution, in which effectively under the authorized OECD approach, functions do determine risk. Functions do determine the ownership or the conceptual ownership of assets, right? Functions do really are the drivers of what's going on. That's an Article 7 concept. That's not an Article 9 concept. And as I've often said on the speaking tours and in writing, Article 7 ain't Article 9, and Article 9 ain't Article 7. Now, having done that, I'm going to turn over. I also want to say something that is important. DEMPE, the concept of DEMPE, is in fact critically important. It always has been. And some of the most difficult issues that we've dealt with historically and that we're dealing with now have to do with these often incredibly important contributions that are highlighted under DEMPE, right? And so therefore, it's not really need to think hard about what is the appropriate return to those things. But it's not a characterization principle. In other words, we are not going to redefine a transaction that actually passes muster under Chapter 1. We're not going to redefine, we're not going to recharacterize it based on some concept of DEMPE. That to me is a fatal flaw. So with respect to the answers, and again, so if I'm the teacher grading it, right, and you have no right to challenge what my word goes, I think we got a lot of it wrong there, folks. A lot of the answers were wrong in my view, right? And EY, we always give these types of presentations, and so where we treat the audience very gently. So we would say, well, instead of getting an A+, you got every answer wrong, so you only get an A- on this. Now, I'm being a little flip because obviously there are nuances in each of the questions, and in a sense, the questions weren't fair because it often happens to be the case that where there is DEMPE, there is risk assumption, and so factually it could align. Where there is DEMPE, it might in fact, under a proper evaluation, lead to some profit split, right? I am not at all minimizing the importance of this concept, but it has to be put in its proper place.
Michael, thank you so much. And I think we have a question from the audience, which you will like and will clarify your recent point. So Yegor Mizerny is asking how to interpret a certain provision from the OECD guidelines, which is the MME group members making the more significant contributions should receive relatively greater remuneration. So the question, if multiple entities perform DEMPE functions, should it automatically lead to a profit split?
No.
No.
Unreservedly, no. It might lead under the facts to a profit split. But if you actually look, we thought about this a lot when we were writing this guidance. When you look at it, Chapter 1 actually deals with the fact, hey, these are multinationals where there are really important people doing things everywhere, right? And so we said, look, let us not simply go for some search as to who does the most control over risk and based on DEMPE. Let's not do that. Let's set up an analytical process by which we will evaluate whether the contractual allocation of risk properly passes muster, and if it does, we then say we have the transaction, now let's price it. Concepts of DEMPE are then valuable in terms of figuring out how do we properly pay parties. But this is transfer pricing, right? It's almost never the case that there's a hard and fast rule. So there definitely shouldn't be a hard and fast rule that DEMPE's happening all over the place. Therefore, there should be a profit split. Right. That's conflating Article 7 and Article 9, and we simply can't do that, in my opinion.
Okay, thank you so much.
May I ask one question to Mike in that respect to clarify that even a little bit further?
Of course.
Mike, I remember you have published a great article about the misconception of DEMPE, in which you even clearly point out where the idea of what was just asked as the question, which I think was an extremely relevant question, that many people indeed have the idea that if two people or two parties contribute to DEMPE, then you would automatically have some sort of profit split. Where in Chapter 1 you can put your finger on what the reasoning is, how you argue your argument.
Oh, well, Chapter 1 is not at all a proscriptive chapter that says you have to do this or have to do that. Chapter 1 plays the strong suit of us transfer pricing people, which is a process-based. It's like, hey, you're going to be gathering facts along the way through your functional analysis. Part of those facts, Rutger, are the contracts that you're looking at, which established from the taxpayer's perspective on an ex-ante basis, right? Before risks plays out, it does things like, hey, we're putting the stake in the ground. This is the entity taking the risk on this, right? And we run it through process-wise, a threshold test where we say, hey, okay, contractually entity A is contractually assuming risk. Does it actually have control over those risks, which is Rutger, which is a defined term. It's not some colloquial meaning of what is it? It's a defined term. Does it have control? Does it have the financial capacity to bear the risk? And in the case that it does, it's like, good, we have defined the transaction and the risk taker. Then we move on to, hey, notwithstanding, we're recognizing you as the risk taker and maybe the legal owner. Look at this other side that has been developing this thing over the years and has made all of these breakthrough contributions. They need to be appropriately remunerated. But that doesn't mean there necessarily needs to be an ex post profit split or anything like that. You simply apply the guidance that, I'm sorry, we have been applying for 40 years that say, how do we use the tools of economics to appropriately remunerate this other entity, not the risk taker, not the economic owner, not the legal owner, for everything it does. And what many people, to me, Rutger, talk about a transfer pricing problem in terms of, hey, this is basically allowing a particular transaction to be respected. And as soon as you respect this transaction, there's going to be base erosion. I would say, no, that's not true. We can respect a transaction, but if there's a problem of BEPS, it's a problem of valuation. There's either been a misapplication of a valuation method or some other thing that is allowing the parties to go down the wrong road in accepting a legal, risk allocation and properly pricing it. From the US perspective, BEPS was a problem of valuation and not of recharacterization.
And I have a few more questions to you and also maybe to Marta, like to have your opinion. So if you don't do profit split automatically, that's the first question, what do you do then? And the second question is somewhat related, is that, of course, not in case of routine functions, but DEMPE assumes that functions are not routine. So can you be more precise on this point?
See, again, people are going down this road about DEMPE, and they're giving it a life that I don't think it was ever intended to have. With respect to the profit split, the beauty of the transfer pricing guidelines is, right, they have all of these methods to apply, right, for any fact pattern. And if the guidelines were to say, hey, where you find DEMPE, you should be applying a profit split, that would simply be wrong. Let me give you a couple of examples. There are other methods. Basically, it's like the US income method that allows the legal owner of the intangible, the funder, to effectively get on an anticipated basis simply a return on its investment. In anticipation, it's going to be earning some return, 10%, say, on its capital put at risk in anticipation. And the other side gets everything else, right? The DEMPE provider gets to me, that's a very powerful example. It would certainly be made less powerful if it was replaced with, we're going to do some anticipated or profit split on anticipated profits, right? That's the beauty of the guidelines, that they do not say you have to use a particular method in a particular situation. So I'm very, not only am I strongly against a proper reading of the OECD says, if you are applying some rule of thumb about what happens when you see DEMPE, you're wrong, because it's specifically supposed to be case by case, functional analysis, bespoke analysis of what's going on. And you have a number of tools in the valuation guidance, which include profit split, but it's not solely profit split, about how to properly value these things. So don't shoot yourself in the foot by being sort of tied to a cross of DEMPE.
Yeah, and Michael, on this point, just to add here, I think it makes sense to also remind people that we are, as you mentioned, we have these multiple methods that we have in OECD guidelines. And the point is, it's not always profit split. And there is this tendency, especially recently, right, to go into profit split just to get the higher remuneration in the country where tax authorities are willing to see more in revenue, more in attraction, more remuneration. But to your point, that's absolutely right, that you cannot just apply profit split as all size fits all, right? One size fits all, because this is not the purpose of the guidelines, right? And it's not intended to be just to boil it down just to one method. So that's just to emphasize this point. Yeah.
Michael and Marta, we also have a question from Isabel Verlinden, our also dear friends, and greetings from her. So the question is, Mike, but doesn't this reflect a somewhat US tweaked interpretation? I tend to see somewhat divergent stances in Europe. Few countries consider that DEMPE should, in first instance, serve to see whether the contractual allocation of risk is to be honored. And that's why we have actually today Michael from the United States and Marta from Austria, from Europe, to answer this question.
Okay, let me say something, Isabel. And I know she's a wonderful person. She's a friend. But it's funny, but everything I've been talking about, it's true. It's absolutely true. In the beginning, I talked about the US regulations and how we do it. But everything else we have talked about has been grounded in the transfer pricing guidelines, the internationally agreed standard that the OECD countries or the pre-inclusive framework countries have established. So I am not talking in this substantive conversation we have. It's not grounded in 482 of the US regulations. It is grounded in what's actually written. And I think, Isabel, what you said is right? To me, I think it resonates with the process point. We have this process by which we are going to really kick the tires on what the taxpayer is saying is the assumption of risk, and where returns to assumptions of risk should go. But that's the process by which we don't just blindly accept it. We said, okay, if that's the case, you need to be demonstrating that you can do the following things. Only then will we recognize it. And by the way, even if you pass this test, that doesn't mean you're going to get any necessary share of the profits. It could be incredibly small, depending on what else is going on. All of those concepts are embedded in the transfer pricing guidelines. So this is the standard by which all of these countries that are honoring their treaty obligations are, I'm sorry, Isabel, in my opinion, not properly applying. And I wish she was live, that we could have a talk. She's wonderful.
I can give her, if Isabel wants, I can allow her to talk. I don't know if you could just write in the chat.
We have more panelists growing as we move along.
By the way, if you want to be live and actually talk, then you have to raise your hand, and then I will see you in the list of participants and will be able to allow you to talk. Sorry, it's a technical thing. So
just 10 seconds.
What?
So sorry, I'm the party crasher here, but I couldn't agree more, Mike, and thank you so much, everyone else here, for organizing this. I just wanted to say, fully agree, but we do see a sort of binary assessment in many factual situations. It's either TNMM or it's profit split, but there is nothing kind of in between. Whereas DEMPE should start in the first instance to serve as, can I honor the contractual allocation, so the control over risk as laid down in the contracts, and then we're going to deal with pricing. That's all I wanted to ask, and Mike, you confirmed that. So Marta, if you don't confirm, I'm going to try to virtually throw something at you. So
absolutely, Isabel. So nice to hear from you. First of all, it's a long time since we last spoke. I will actually build upon what Mike said just in this half an hour on contracts and why we are looking into contracts in first place, right? Why we start this analysis with the contracts, right? And what does it mean and how it should be interpreted. And again, I'm not imposing my view, but just as a matter of discussion to give a little bit of perspective what contracts actually mean. So let me just start from the very beginning, because this is what Mike mentioned, I believe, as the last point on his slide, that not to mix up Article 9, Article 7, right? So what is Article 9 is all about? It's basically, it's arm's length principle that is originated in a contract law, right? So it means that it's basically the background for us to say, okay, who is assuming the risks, right? Who is exercising control over such risk, right? And you may have come across this statement that I put here on slide: risk contractually assume, party cannot exercise control over risk, right? Not financial capable of the risk. So the problem with related party transactions, that it's not something that you would see in between independent parties, because independent parties are willing to negotiate, and the result of their negotiation is in the contract, right? So that's why there is no point to challenge the contract if we are talking about independent parties. The problem with, or not the problem, but the difference that we see with related parties, that we have this ability within the group, and I now see it even more being in-house than on advisory side. It's very difficult, even if you are, you are not necessarily trying to, make up some transactions and avoid taxes, and it's not the case, I would say, at all, at least in my group, right? But the issue is that you're trying to figure out what third party would do in these circumstances, right? Or for this transaction. And this is how you should look into contract itself between related parties, right? And to be able to say, okay, I'm comfortable with the contract that we have between Austrian sub and US, parent. So the way you can do it is to look into guidance, and you will see, if you may go to the next slide, Svitlana, thank you. So what you will see in the guidelines, these three criteria, as I would put it, right? It's substance, it's ownership, and it's commercial rationale, right? What we are looking at, why we are putting this contract in place, we want to make sure that the transaction is, reasonable. It has all the attributes that you would see in the third-party transaction, and the parties who are entering the contract, they are taking the risk. They are, they are exercising control over what they are committing to, right? So contract is not something that, it doesn't matter anymore, and that's why OECD put it as a first step. So why we are starting with the contracts? Because the contract would tell us what you put inside. It's not necessarily, we are starting with the contract, but it's not the end of the story, definitely, because we need to test this contract, right? And the way to test it is to look into these three criteria here that you see: substance, ownership, commercial rationality, and make sure that what we are putting into contract, it makes sense, if you put it very simple way. So if you, Svitlana, can move please to the next one. Right, and what is the substance? And I believe Mike can add a little bit more on this from the US especially perspective, right? Because this is the key concept if you look into 482 regulations. So it's actually tests, right? What is economic substance? It actually gives us this examination, right, whether the contractual parties have this capacity to perform this contract. Because when we are talking that the transaction doesn't make sense because the party cannot, it doesn't have, capacity to do the work that it has committed to do, right? So it means that the contract itself doesn't perform. So in a third party setup, this contract would not even take place, right? It would not be put into, signed or put on paper because it doesn't make sense. So that's why economic substance is something that gives you this testing tool to see whether it makes sense what you see in the intercompany contract, right? And then coming to DEMPE concept. So here where you can, kind of test the contract from the perspective of this capacity to perform the contract, meaning the DEMPE concept, whether you have staff, very easy, whether you have staff to do the work that you are willing to do according to what you put in place, right? So I believe that the concepts that we are looking into, this is something that should be, first that comes to mind when we are talking about the transfer pricing analysis in first place. And then, as Mike mentioned, DEMPE is not about, it's about valuation. It's about how much it should be for this, service, for this intangible assets, whatever you are putting in place between the two related parties. What is the value that you are trying to allocate, right? And the way you allocate it, this is what you would use the methods as a tool. And I agree with Isabel. So it's like we are talking about two main methods that are now being used, which is profit split and TNMM, right? Because this is the way it works in practice, right? So yeah, Mike, go ahead.
No, I disagree. And Isabel, I'll let you go. But I'm sorry, you guys. You have been given this beautiful set of guidance, very carefully drafted, to be effectively empowering in applying the arm's length principle. And for things to sort of break down to a system of, we're going to do profit split or we're going to do TNMM. That is such a tragedy because, for example, there is something that's even more powerful included in terms of rewarding DEMPE functions, right? More powerful than profit splits. And that is found in, for example, example 6 of chapter 6, which basically lays out an example that says, yeah, A is the legal owner, right? A is the legal owner, and A is actually contractually assuming risk. But B has basically done everything and is going to continue to do everything. There's a method more powerful than a profit split that basically says, yeah, A is going to get an anticipated return on what it's put at risk, because risk is real, and B gets everything else, right? So that's why I say these guidelines are even more empowering than profit split versus TNMM. They allow you to apply all of the available methods to get to the right economic result in any fact pattern. And Isabel, so the fact that sort of we're going into a binary TNMM versus profit split means there's some intellectual laziness here, right? You're not using these empowering transfer pricing guidelines that were so carefully drafted. So Isabel, you're defending Europe here. So, right, so you're Europe right now.
May I also intervene asking a different question to both of you from Richard Collier, and also I think you all know each other. So his question, isn't the problem that there is an ambiguity in the guidance, paragraph 1.105, that is argued by some tax authority to open up the door to alternative interpretations, breaking the clear distinction between delineating the transaction and pricing it?
No. And I can answer why. It's a brilliant question because Richard's right. Paragraph 1.105. Paragraph 1.105 is, by the way, it's a sentence that says and its location is, we've already determined what the transaction is, right? So, and let's, for purpose of the example, say, we've already determined that the transaction is what the taxpayer says it is under the contract, that is party A is assuming the risk. So, right, so that means it's gone through the substantive test of what it means. All paragraph 1.105 says is, hey, there may be other entities that are contributing to control over risk, right? It's possible, right? Because this is multinationals, everyone's helping out. And yes, notwithstanding that contractually the taxpayer did assume risk, hey, they're getting some help. And it says, so you have to obviously pay them for that, whoever is helping control of risk. And then the end of it says that that may include, you know, effectively sharing in the risk, right, through effectively a profit split, right? But if you read that, and so yes, Richard, a lot of people are saying, oh my God, the paragraph 1.105 turns things on its head, but it doesn't. And I've written extensively on that. If you look at 1.105 and where it's placed in chapter 1, which is effectively after the transaction has been defined, you will see that at that point, any method can be applied, including something akin to a profit split, but only if it's consistent with the accurate delineation of the transaction. In other words, you can't use 1.105 to effectively overturn everything that came before it in terms of the contractual assumption of risk. That would be dumb, because effectively, instead of writing 50 paragraphs on what it means to assume risk and how we go through it, you would simply point to paragraph 1.105 and say, well, you know, if different people control risk, they're going to share it. In other words, that's a reading of paragraph 1.105 that effectively nullifies everything that came before it. That simply can't be correct. And so therefore, Richard or anyone else, if people are saying, look at 1.105, it's a trumping paragraph, I would argue that they are not properly reading this brilliant guidance that has been handed down to you from very smart people. Sorry, that last comment was gratuitous. I take that last one back.
Yeah, but actually it just elaborates the next slide, Svitlana, if we can move to the next one, what Mike just mentioned. So we are going to this you know, next concept that would allow us to test the contract. And the next one is this ownership, right? And this is what we discussed at the very beginning of the presentation. The legal and economic ownership is basically one ownership, right? That's why it was dropped eventually, right, Mike, in the OECD guidelines. So the ownership itself, it means entitlement to something, right? If you are looking at it in a broader sense. So when we are talking about transfer pricing, we sort of do not believe that the company is claiming, okay, this SAP is the owner, right? And the way to test it is to evaluate this financial and functional capacity of this SAP, of the subsidiary, right, of this company, whether it's actually is capable to perform what is what this party has committed in the contract, right, in the first place. And this is about the delineation of transaction. So once we have the transaction, we have the contract, right? Let's put it in broadly. And once we have it, so the next step would be is to evaluate what is the remuneration that should be put in place, right? Who should earn what? And if we are talking about the ownership itself, ownership is already has this entitlement to remuneration, but the question is how much it should be, right? So it's not about disregarding the ownership completely. It's about giving the, I would say, price tag, right, to the parties. And this price tag is actually estimated or is drafted based on the factual setup within the company, within the group, right? And that's why I put this last bullet point here. So as a matter of law, of contract itself, right? Ownership it has this entitlement to remuneration, but factually, we would need to understand, looking into, DEMPE and a functional analysis, how much it should be, right? And this is what, again, coming back to DEMPE, it's a valuation exercise. So this is something that will tell you how much it should be that the company would need to pay for service, for products, whatever we are covering here.
And Marta, that's brilliant. And can I also add, I think you've nailed it here. And there are really good examples in the OECD guidelines about recognition of ownership and what it means. Examples 1 through 3 in chapter 6 basically has a situation where there is a legal ownership. Congratulations, you're the legal owner of this. But your return for your legal ownership is pennies on the dollar, because basically all you're doing is administering the contracts as opposed to things like that. So the notion of respecting legal ownership doesn't necessarily mean anything with respect to what the returns of legal ownership are. That's factually determined. And again, there are examples all through chapter 6 that sort of say, we are respecting legal ownership, but we're not ignoring the economics.
Right. Absolutely. So that's the key takeaway, I would say, from this discussion so far. And the next one, the last one, Svitlana, if you can move please to the next slide. It's about commercial rationality, right? So it's always you may come across quite often that in the discussion about transfer pricing that that it's sort of avoidance, right? So transfer pricing itself, but it's not the case. So transfer pricing is a neutral concept, right? To start with, it just happens that you have companies that are under common control, right? But it doesn't mean that they are tax avoiders in first place, just to make it clear. And the commercial rationality principle, this is something that actually gives you this test, or this possibility to test the relations between the related parties. Even if you are coming with this, assumption, there could be some avoidance between the parties because they tend to, or they have ability to agree on whatever they would like to agree that would eventually may lead to profit shifting, to base erosion, and so on. But the point with commercial rationality is that something that is irrational, right, doesn't have place in the contract then. So if you want to test the contract, you would need to apply this rationality test in addition to ownership, in addition to what we discussed, who is the legal owner and whether the contract has substance at all. And this is something that gives you this, I would say, parameters, right? When you see the intercompany contract, where should I start with? Should I go to the parties, talk to financial director of the company or CEO or CFO and ask, are you really selling these products? Are you literally providing the services? No, the very simple task is to look into these three concepts, right? And put in place the step plan, basically, to see whether I can test the arrangement that I have in this contract from the perspective of substance, from the perspective of ownership, right? And this commercial rationality. And this is just to give you, to give the audience this a little bit of background to take this step back and give the tools how to test the contract, because we all agreed, I believe, that the delineation of the transaction itself, this is something that you can you can see in the contract if you believe that the transaction itself is a real transaction, and the way to test it is to apply the three concepts that you have here. I don't know, Svitlana, if you can move now to the next one. And I believe this is something that would lead us to the practical example. And I would ask Mike if you would like to add something here before we jump into
no, please go ahead. And I think I'm with you.
Marta, maybe I'll ask you also something before we jump in the practical example related to clarifying your ownership thing, the clarification. So the question comes also from Sebastian, the book, right, from Unilever. And do you think what would be needed to repair the misconceptions on DEMPE, both the current resulting in a year income allocation misconceptions, but equally the economic IP ownership misconceptions, as applied maybe in tax audits? Do you think that the OECD should restart to work on TP transfer pricing guidelines, and what specifically needs clarifying in there, or maybe actually repairing?
Who is that? Marta, go ahead.
About economic ownership and legal ownership, how do you think it would possibly repair all these misconceptions?
You mentioned it's Sebastian's questions, right? So I think, and please, Sebastian, correct me if I'm wrong, but I think what you are trying to make a statement that the ownership actually should be respected, right? And there is this misinterpretation, basically, that the tax authorities tend to disregard the ownership itself, meaning that they don't believe that what you have on paper, right? What you say, okay, I am the principal, I am the owner of this service, right? Of this outcome of the service, and this is the issue that. Well, if you're asking me how it should be dealt with by the OECD, I don't think that it would be helpful to update the guidelines itself. But what would be helpful, I believe, to put a little bit more into commentary on Article 9, because what we have in the commentary, I believe it's still 5-6 pages, and it's very little, right? If you are talking about, interpretation of the principle, which is so broad that people are just trying to, both tax authorities and taxpayers, so it's on both sides, are trying to find a way how to interpret it in a way that would benefit them, definitely, right? And it's actually the common issue with all principles, right? Because this is not a rule, and so I would say, if you're asking me, I think the commentary would need to be updated with more precise, I wouldn't say interpretation, but with more precise, wording that would make it clear that you should respect in first place what part you have, and challenge not the facts that are there, but challenge the way they evaluate the value. Right, so that's my take on this. And Mike, you
mine would be no, I don't think the transfer pricing guidelines first and foremost need to be rewritten. The transfer pricing guidelines need to be read, because and again, I've written extensively on this. A lot of these positions that are being taken with respect to what DEMPE means have no grounding in the transfer pricing guidelines themselves, right? The paragraph 1.105 was an example of that. And so, look, the transfer pricing guidelines, it's true, there's always a knock. Things are a little fuzzy, right? It's hard. And in transfer pricing, that's true, right? It is true that there's always bits of fuzziness, but that's not the fundamental problem here. The fundamental problem is that apparently people are taking these concepts and doing with them what they think should be done, rather than actually reading the transfer pricing guidelines, which lays out quite carefully how these things are supposed to be analyzed. So that would be my recommendation.
Maybe it's also a little bit of what George Orwell already said. We started off with all animals are equal, but we ended up with but some are more equal than others. And there is always this point that people have an interest in reading things the way they'd like.
And that's the thing, and Rutger, it's true that where there's ambiguity, it's true. Where there's ambiguity, there's a problem, right? Where, okay, those are the types of things that need to be maybe further articulated. But what I'm finding is a lot of times it's not it's not a reading of an ambiguous term. It is misapplication of a clear concept in the transfer pricing guidelines that I'm seeing a lot of.
Mm-hmm. Can we move on to the great examples that you have prepared?
Yeah, I think we are good to go. And Svitlana, if you can please go to, thank you to the next slide. Rutger, to your point, it's not me who prepared this example. It's Australian Taxation Office, and this is what I found very relevant to our discussion if you are talking about DEMPE and contracts, right? Because this is exactly the real life situation, I would say, that would be relevant for, if not all, for many multinationals. Where we have, and let me start with the background, and I found it interesting, as I said, for this presentation, because it gives you this, real example how the things are at the group level, and where the challenges that the company may be facing, and what Australian Tax Office ATO is putting here. Is their view that the arrangement that we will be talking about in this presentation can be interpreted or can be scrutinized by the tax authorities, not only in Australia. It's just, I picked this location firstly because, we also are present as a group in Australia, and also it's interesting. Write up what their view is on such setups. So let me start with the background. What we have here, we have a local company in Australia, right, which is Australia Co. And this company is the IP owner, right? So it has existing intangibles. And it has all the attributes, which is a capacity to basically manage and exercise control over these intangibles, which is basically DEMPE substance, DEMPE functions, right? And this is the arrangement they had in place before they started with the new one. So Svitlana, if you can go to the next one. So what this local company in Australia did, they signed a contractual arrangement. So they enter into a contractual arrangement with its foreign affiliate company, which is Foreign Co, right here. And they agreed that they will be providing R&D services on a cost plus basis, right, to that other company. And those services will be resulting in a new intangible, right? This is what you see here as next to Foreign Co, new intangibles. So it will be, if you put it in transfer pricing language, it will be a contract R&D based on cost plus, let's say 10%, right? And at the same time, the intangibles that the Australian company has will be eventually, decreasing in value, in significance. But at the same time, the Australian company will still be getting, royalties based on the license agreement it has in place for the existing intangibles, right? And what the issue that tax authorities are seeing here, and again, it's about Australian tax authorities. They are looking at it from their perspective, right? defending their national interests. So what they are saying, what we see here is that the income from the existing intangibles that you have here, right, it's actually declining, right? Because the company is not investing into these intangibles, right? There will be no, if I'm talking about software business where I am, so there will be no new releases of software, no enhancement of software. So existing intangibles would eventually not be of the same value, or they will not be valuable, or let's say the customers will not be willing to pay for subscription of such software product. Let's put it in a more understandable way what we are talking about, right? But at the same time, the Australian company will be investing the same, so it still has the same personnel, the same staff, the same expertise, right, at the company, and this will be used on a cost plus, basis for the R&D services, which means that you are devaluing your as a local domestic company, you are devaluing your existing intangibles, and you are investing, so you are putting your expertise and efforts into new intangibles that are owned by somebody else, and you are getting for this just cost plus, which is much less than if you are talking about the license income and cost plus remuneration as just a service payment is much less. As a result, lower revenues reported and taxable in Australia, right? So this is the problem that Australian tax office sees here. And Svitlana, if we can please move to the next one. Right. And what ATO is saying that there is inconsistency with what you are receiving, Australian company, right? What you are receiving as remuneration for your R&D activities with the actual, the actual DEMPE functions that you have, because you have the same people, they are doing a little bit different, maybe a type of work, but it's still, related to the development, and you are getting for this just cost plus, right? And at the same time, you are not investing in your existing IP. So what we see here, and this is perspective again of Australian taxation tax authorities, that what we see here is that you are kind of moving, right? It's like a deemed transfer of your IP to somebody else abroad, right? And this actually results into second issue that you see here. It's actually deemed sale of IP. You can look at it from this perspective, even if there is no formal, arrangement in place. But eventually, what this arrangement looks like is that through this cost plus contract that you have in place with your affiliates abroad, you are sort of giving up your income, which would usually be more higher because it's more valuable to have already existing, IP and get the royalties rather than being remunerated just as a service provider, right? And what they are saying, it just doesn't make sense. That's why you have this third bullet point here. We see this lack of commercial rationale here because it doesn't make sense for third parties to give up something that you have, your expertise, your more valuable kind of input, and get paid for this as a regular service provider, right? And this actually gives you this a little bit, of understanding that the DEMPE functions and DEMPE activities can be looked at by tax authorities as something that could be, play with. Yeah, so the company can play around with DEMPE activities and say, okay, the DEMPE is not that important anymore because we changed the arrangement, right? We just put in place R&D contract, but it doesn't help, nevertheless, for the tax authorities to look and, look at this transaction and challenge it, because in reality, what they see, it looks like you basically didn't change anything. You just changed the formal arrangement, right? Instead of getting, royalties for your intangible assets, you just decided that you now will be working on just R&D arrangement with your related parties. And what I would say would need to be done here from the taxpayer's perspective. And by the way, it's interesting to see in the draft of the ATO that they are saying, if you came across such arrangements or you recognize such arrangement exists in your group, please email us. And there is email address that you can email ATO and say, yeah, it's similar to what we are doing. Maybe you can help us to figure out how to deal with this situation and how we can improve as a taxpayer, or how we can protect ourselves from potential scrutiny from tax authorities, to make sure that this arrangement is really something that you would not challenge because it doesn't have this, commercial rationale. If you recall, this one of three criteria that should be in place to test the intercompany agreements. This is back to what Mike was saying at the very beginning. The DEMPE functions is actually this substance itself that need to tell whoever it will be, whether it's internal users within the group or it's external, in our case tax authorities, that needs to tell that this is what we do, this is why we change it, right? And this is what we believe makes sense to us from the business perspective, and this should be put on paper. And the way you can put it is to have, as ATO, if you look into draft, that's why I put it as a footnote. If you look into draft, you will see what type of evidence you would need to provide to tax authorities to say, yes, we really do it that way. So starting from, timesheets, we have in software business, you have JIRA, which is actually gives you this understanding what developers are talking about, how they are working with each other, right? What they are really doing. And all this evidence should play, huge role to justify your DEMPE. Because DEMPE, this is something that would give tax authorities basically this, background information, data, right, that they need to understand, are you really doing what you are saying in the contract? Or you are trying to, make it up eventually to make sure that we are not paying that high, amount of taxes in Australia, which is, higher definitely if you take, R&D companies someplace else, right? So the point I wanted to make here that the DEMPE activities are important, and the way you can approach it as in-house practitioner or as academic, right? If you're interested in this topic, or as tax authorities, is actually to look into detail who is doing what, right? What is really happening on the ground, and not speculate that, we just don't believe that it could be real, right? So it all boils down to real fact. And again, I probably will be, something that everybody, at least who is in transfer pricing, somehow connected to transfer pricing would say, well, it's all about functional risk analysis, right? And it's all about facts and circumstances. And it really is, because this is what transfer pricing is all about. It's about real case, what you have in your company, in your transactions, in your agreements. And this is what is a good example. That's why I wanted to put it on the slides, how the setup can be interpreted by tax authorities, and it's not necessarily could be the case that the company wanted just to shift profit out of Australia. And the way you can justify it is to really dig into details what your people are doing and what you what you have in place. So I will.
Can I ask a question, because I think the example is I believe is very interesting, and it also I think points to where the problems are in performing your analysis. At the end of the day, if and then we may also go back to Mike a little bit. If you at the end of the day say, well, indeed we change the risk attitude, so to say, of this particular entity. We were a risk taker, but we decided to shift away from that and say, well, I don't want to take any risk anymore. Well, actually, this is people sometimes might say this is not happening in reality, but I think Big Four are a big example of it. Partners do eventually resign and just withdraw and keep doing things, but not anymore against the profit share that they had in the past. So it is happening in reality. But having said that, if that is the case, you would say that, and maybe also going back to Mike, then we have to respect that, because it is what people contractually have, or the parties have contractually agreed upon. Is that a right takeaway?
Me?
Is it a question for me or for Mike, Rutger?
As you can tell,
It's a question for both of you.
Okay, so Mike, maybe you can.
Yes, because as you can see, I'm pointing my fingers, which is never a good sign. If we can go back to that prior diagram, I think from the slide, and Rutger, you're making a point, and you even use the term "we have to respect it," and an implication to that, if we have to respect it, then bad things are going to happen, right? Because it's going to open the door to BEPS, because people are looking at that, and maybe they're getting the vapors, because it's like, oh my goodness, this was a situation in which, in this case, the Australian company basically did everything. It had all of the value. Now, all of a sudden, because it wants to sort of be a less risky service provider, now it's going to get paid a cost plus 7. They're using this die on the vine analysis to say that all of the future returns are going to the other side. And it's striking people against their common sense. It's like, hold on a second, that can't be right, because all the profits. But look, again, the guidelines, I think, are very empowering here. And I just want to make this point. There is nothing in respecting this, actually respecting this deal that we see in front of you that are giving people the vapors. There's nothing against actually respecting this and properly preventing inappropriate BEPS. Just to give you an example, and again, this is actually in the transfer pricing guidelines itself. One of the most powerful tools, and its evaluation tools, is the concept of realistic alternatives, right? And so if we're talking about how are we going to evaluate this transaction, are we simply going to respect the cost plus 7 that they're going to get in the future? And to me, I'd say there's a question here. How do we appropriately remunerate this transaction that we are respecting? And so the answer is, well, what exactly are the realistic alternatives for Australia under the status quo? And to the extent, and it's a factual determination, that it actually had the ability and the right to continue to do what it was doing into the future, which is not always the case, by the way, but let's assume it is. That provides some notion of, okay, how much would it be anticipated to make? The ultimate pricing of this deal has to respect the fact that Australia should be getting, at least in present value, what its realistic alternatives are. And the present value can also take into account risk, right? It can be discounted at a lower rate, reflecting that Australia now is a less risky entity. And so actually, you can respect this deal, Rutger, and say, yes, the economics of this will work because I'm applying effectively some income method, a cash flow method. And in order for it to work, the economics are such, given the realistic alternative of OSCO compared to FARCO, sure, we can respect a contract R&D arrangement, but don't give me this cost plus 7, right? Given the realistic alternatives, that should be a cost plus 20, 25, whatever, right? And you're not going to find that in the...
As a result of, as what you say, as a result of that analysis, that financial analysis, which takes into account future income, what you could have expected as an alternative.
That's right. And so therefore, to me that's a key message. There is nothing inherent in respecting a contractual arrangements going through the process. There's absolutely nothing inherent between that and somehow systematically allowing for BEPS to occur, right? They're distinct. And if you properly apply the transfer pricing guidance, where the valuation guidance goes beyond just, scoop of chocolate, scoop of vanilla, profit splits, and T&M, it actually provides some very powerful cash flow based financial analysis. That combined with the concept of realistic alternatives, to me, guarantees that you should be able to get to the right economic answer and not have to revert to recharacterizing transactions, right? We haven't talked about this, but one of the key drivers of the US approach, the US tends to respect contractual arrangements, but we make sure the pricing is right, because the reason is, if the alternative is recharacterization, you said you did that, but I'm going to say you did something else, then we are in chaos, right? Because now we are now trying to interpret the context in which this transaction took place, and we're going to say it's a deemed sale. Well, the other side of the transaction, let's say the other country, if we're now playing the game of we're ignoring the contracts, we're simply going to, deem what the transaction actually happened, why on earth would they be obliged to go along with what the other tax authority thinks the transaction is? Because there's an infinite number of potential transactions and implied contractual arrangements, an infinite number that could support any level set of facts on the ground. That's why it's important to me that, the chaos that would be involved if you simply gratuitously ignored contracts and things like that, right? That's a real cost. And therefore, it is probably more effective ultimately for everyone, right, to not just gratuitously recast or recharacterize transactions, but to properly apply the valuation guidance, right, that can still get you to the appropriate economic result.
Yeah, and an option realistically available, to your point, Mike, in real business, and I can tell you, being in-house for quite some time, in real business, it's not, something that you would see from the perspective of tax, but you should look at it from the business perspective and real business decision. And the business decision for this structure could be either you accept the cost plus this remuneration, right? Because you have, you know the business, you know how to develop the software or similar software. So either you accept this as a company, right? Because this is what management in the group, let's say in the US may say, or we are closing down the business and we have all the right to do so, right?
I couldn't agree with you more.
Right. And there is no option. So this is this realistically available option for the company. Either we are closing it down and you are looking for a new job in Australia, right? Or we are offering you this, right? And let's see how it goes. Maybe eventually we will also, develop it in a separate. I don't know.
I couldn't agree with you more. When I talked about realistic alternative as a powerful tool, there's also misapplications of realistic alternatives where it's saying we are going to assume that what's going on could go on forever. And it's like, okay, that's not really the realistic alternative here. You actually have to ground it in the facts on the ground. Sorry, Rutger, I interrupted you.
No problem. Thank you. I think it's a very relevant addition to. We have, I think, one final question, Svitlana, to which I think will contribute to the discussion as well. So
yes,
maybe...
in the sake of time, we apologize for all the questions in Q&A that are answered. So potentially you could contact our speakers afterwards to ask the question. So I'll take only one last question. And yeah, so we have a hand raised. And please, Federico.
Yes, thank you. Oh, so let me recap, Michael. You said and you wrote in your article that DEMPE and non-recognition are two separate and independent things, right? Because no mention of DEMPE is included in section D1 and D2 of chapter 1.
He's setting me up, I can tell. I can please continue.
And these are two separate steps. But I'm not sure if I agree with you on this. Because, I mean, why should the OECD have mentioned DEMPE in chapter 1, so section D1 and D2, if a specific chapter to supplement the first when dealing with intangibles exists, and indeed is the place in which DEMPE takes place? I mean, mentioning DEMPE in chapter 1 would have meant extending it also to transactions that have nothing to do with intangibles. And in general, I feel that, okay, delineation, recognition, and pricing are for sure different things and different steps, but they pursue the same purpose, which is the correct application of the arm's length. And DEMPE contribution, I think that in general are important when we access the commercial rationality of a transaction.
DEMPE is definitely important. Like I definitely agree that the concept that DEMPE is looking to could actually be sort of the critically important and maybe most difficult aspect of any transfer pricing case. Right? And again, that's been true for 40 years, right? DEMPE is not actually something new, notwithstanding there's a new acronym. But no, the guidance was actually, Federico, the guidance was actually very carefully drafted, right? Because we wrote the new chapter 6 we released it as a package, right? Effectively the final guidance, chapter 1 through chapter 6. And so chapter 6 was written at a time where, yes, we knew what the guidance was in chapter 1, right? But if we really wanted, and we being the OECD, if we really wanted to clarify how this concept of DEMPE somehow interacts with the concepts of control of risk, right? Given the importance of it, we would have clearly delineated that, all right? We would have clearly articulated that in chapter 1 or in chapter 6, say, hey, when you're reading chapter 1 and control of risk, here's the relationship. But the guidance doesn't do that. And to me, that was, I think, that was actually an explicit decision to say, again, to me, that makes sense because DEMPE is a valuation concept, right? And the guidance on chapter 1, you can get to the appropriate determination following the process of section D of chapter 1 without having to revert to this concept of DEMPE. They're separated, in my view, for a reason. And absolutely, the United States, as one of the countries, just one of the countries going through this, went through every sentence and every paragraph and looked at the relationship between them. There was nothing really accidental about it. And so, again, I really think that instead of trying to read something into the guidelines that is not explicitly there, one should instead try to maybe more carefully look at what is there and see how these incredibly important concepts of DEMPE, very important, and accurate delineation of the actual transactions relate, right? And I don't think they do directly relate.
Okay, thank you so much again, Michael and Marta, for this very interactive discussion. We had many questions from the audience, which I really enjoyed. And so all your different opinions really contributed to this interactive opinion discussion.
Thank you so much for including me. This has been so much fun.
Yeah, thank you, Svitlana and Rutger, and the audience, for the questions. So it was really interactive and fun to participate.
Yeah, I'm positively frustrated because I wasn't able to pose all my questions, which is, I think, is a sort of a good sign of.
Let's do it again. Let's have
a
part
great
2.
discussion. Yeah.
Let's do part 2, Rutger. Let's do it.
Why not? Why not?
We can do part 2 with Q&A, just Q&A.
Yeah, that'd be fun.
Thank you so much.
Thank you so much, and have a nice rest of the day.
Thanks,
Thank you.
everyone. Take care.
Thank you. Bye.